Welcome. Welcome to week 5 and chapter 4 of our accounting class. Chapter 4 is another complex chapter with a lot of new information, and I'm going to try to adjust my presentation here a little bit this time to focus on some areas that I think may help you more. So if you found the past videos helpful, think about if you find this one more helpful, and if you don't, you can let me know. But if this is an improvement, you might let me know that too, because I think that I need to make some changes. So here we go. First of all, I want to remind you that in weeks 1 and 2, we studied chapter 1, and we looked at the accounting equation, and the accounting equation was assets equaled liabilities plus owner's equity. And at that time we said we would be expanding the accounting equation, which we have certainly done by chapter 3, and even more now by chapter 4. I would encourage you actually to reread chapter 1, and if you don't want to read the first part where it talks about being an accountant, but just start where it talks about accounting, I think you'd find it would be so much more meaningful to you at this point. You'd be able to read it faster with greater understanding, greater comprehension, and it would be an excellent way to solidify your foundation for studying accounting. In week 3, we looked at chapter 2, and that was about adjusting entries. And what we said was adjusting entries have to be written because of the passage of time. Due to the passage of time beyond the cash transactions that are happening in a business, we need to match the revenues that are generated with the expenses that are incurred in order to get a profit, a meaningful profit, a profit that truly says, given what we had to, the resources we had to expend and the obligations we had to take on, here is the amount of profit against those revenues. So you will, again, if you would reread chapter 1 this week and then maybe reread chapter 2 next week, you would find they would begin to make much more sense to you as we get farther and farther along and your understanding is more relaxed. I think that's the biggest thing. When you're reading things at first, there's great tension about what you're reading, and I'm going to try to help you with that a little later in this presentation. Now in week 4 and chapter 3, that's the week we're in right now. I'm recording this the week at the end of week 4. You're studying the theory of debits and credits, and I said to you that much of the information about the theory of debits and credits was presented to you on page 140. So I said, just look at page 140, read the top of page 140, and get an appreciation of what the theory of debit and credits is all about. There's a very handy table at the top of page 140, and there's a corresponding table at the top of page 150. Now, I'm telling you these page numbers so that hopefully you will write them down, and hopefully you'll go back and look at them after this presentation. Look back at page 140 and 150 to get that theory of debits and credits. Remember, assets are on one side of the equal sign. They sit there by themselves, and for them to have to go up, we're going to debit them just by assumption. Then you go across the equal sign, you're going to have to change the sign of the way accounts are increased. So liabilities, owner's equities are going to go, revenues are all going to go up with credits, but expenses have a minus sign in front of them. So there's an inverse relationship over there on that side of the equal sign, because expenses are going to make that wealth of liabilities and owner's equity go down. So therefore you will increase those with debits. So as you think about this equation, debits are increasing assets, but they're decreasing liabilities, owner's equity, and revenues. So credits are decreasing assets, they're increasing liabilities, owner's equities, and revenues. And they're decreasing expenses. Now that is a bit confusing to just say it or to just read it. It's not very meaningful generally to just say it or mean it. You need to become engaged, active readers, engaged, active learners. You need to pick up the pencil when you read a transaction. You need to study it right at the time. You need to try to gain an understanding of each event as you encounter it in the chapter. And I'm going to try to do that with you in this presentation. So in this week 4, another thing that has come up is there any place where you can see these accounts names and what they mean. And last week's presentation, I said to you, look at page 152 to 155. That's the best list of samples of transactions, theory of debits and credits for journal entries, names of accounts, income statements, balance sheets, so you can see the relationship of accounts, and then the closing entries. So write down page 152 to 155, put a marker in it in your book so you can get back to it, and it'll be a handy, ready reference for where what the account names are, for where they reside in financial statements, and for their functions. So that is my review. That is my welcome to Chapter 5. And I hope that you will take me seriously about reading Chapters 1 and 2 over again and getting an appreciation for them, and then maybe in the third week read the theory of debits and credits over again, because by that time you should be familiar enough with it that you'll see that it's a much more comfortable and meaningful read for you in Chapter 3, week 4. Now, let's move on to week 5. That's where we are now. Let's look at Chapter 4. Chapter 4 is about the merchandising business, as you can see on the schematic behind me. And the merchandising business begins on page 208 is where I have it written down, and 206 and 7 give you a nice introduction. A merchandising business is a retail operation. They're a business that sells to consumers, and they can be wholesale as well, but generally wholesale is between businesses. And so merchandising business tends to be, it can be wholesale, but we tend to think of it with a retail operation. Looking at page 208, you have another one of those pages of account titles, account balances, a comparative balance sheet of a statement of operations, an income statement for years 10, 9, and 8. And that's where we're moving to, is these uniform financial statements that can be compared for the purpose of the financial statements, that they have comparability, that a potential investor, a potential lender could look at 3 years side by side and get the same picture. Those would be comparable, they would be comparable, and they would serve a function then for investors and creditors to decide if they want to continue to buy your stock or to loan you money. Now when we look at 209, we then begin to see a uniform income statement or statement of operations, and notice how much more information is on one than is on the other. There's still comparison, but the uniform statement is much more compressed. And so you begin to see that not all the accounts are presented, but enough information is presented that you can make comparisons, or that a decision maker, an investor, a creditor, a person working for your business could make comparisons. So I want to point out 208 and 209. You should mark those. They're going to give you a lot of the names of accounts. Are all these things, are all these accounts written down someplace? And they are written down someplace in these various page numbers that I'm giving you. So be sure that you note the page numbers and go forward from there. All right, then on page 209, we start the accounting for inventory transactions. And on page 209 is some particularly important information for you, a lot of key terms, and I think you should take time to really study page 209 carefully at the bottom. There are three groupings of costs, three groupings that we use for costs. They can be grouped as product costs, costs that we spend to make our product available to our customer. So those are the costs that we spent so that we could say, here it is, buy it from us. Now, we're going to be learning a number of new accounts this week, another number of new accounts, I guess I should say, and we're going to be putting some more product costs into that group. So I'm wanting you to get the term product costs, and I'm wanting you to get the understanding of what kind of costs would go in there. And there will be several new ones this week. Period costs are costs that we incurred because of this time period, because of this year ended 2013, December 31st, 2013, then we're going to have a certain number of costs that are just because of that period of time. So for instance, we would have insurance that we had to pay for the whole business, not just one product or just not one location. And so we would have insurance costs for the period of January 1 to December 31, 2013. So there will be some costs that we'll put in this category of period costs. Because of this time period, we had to incur those costs. And then we're going to have administrative costs. That's our third category. And administrative costs are the cost of oversight for the entire operation, and we had to incur those costs because we needed to administer and organize and manage this business and this operation. So some of the administrative costs would be costs such as our information system. We needed that information system so that everybody could use the same computer system and everybody could access information about the business, about the operations, and so that needed to be an administrative cost for the entire place. There's a fourth group that we're going to introduce you to a little later, begin this chapter but introduce more, and that's going to be selling and administrative. So we're going to expand this administrative costs to include selling costs, and that would be the cost of marketing our product and having our sales force and getting our product to the customer. So the sales costs could be very, very different. And I just ask you to think about maybe some businesses that you know. Maybe you've been in a Nordstrom's, and the selling operation in Nordstrom's is much different in contrast to the selling operation in Costco or Walmart. Costco or Walmart feels like a big warehouse, and you're walking around and looking for things yourself, whereas Nordstrom, somebody's playing the piano, there's a coffee bar nearby, there's a wine bar nearby, and you have private dressing rooms, and it's just a much different selling experience. So those will be some of the differences in selling and administrative costs. But that's in the future, so let's stay with this chapter for now. So page 208 and 9 for lists of accounts, and you can mark this one and get back to it and look for some of these account names and categories. You can begin to read very carefully the bottom of page 209 where we have these, my eye went back there and I see it does say in bold selling and administrative costs, so this is the place where we're introducing them to you. My notes, I didn't catch that, my fault, sorry. But you can look at those categories of costs and begin to understand them. As we turn then to page 210 and look at page 210, we're introduced to the cost of goods sold and to the concept of cost of goods sold, to the expense called cost of goods sold, and to the cost of goods sold formula. We begin to break that out, and we'll use this formula in several ways. And so I want you to read the top of page 210 carefully. Again, it's quite colorful, and it introduces you to these merchandise operations that bring in merchandise and go through the process of selling it, and then maintain an inventory in order to have goods to sell to the customers, and then divide that the sales that come in between the cost of goods sold and the gross margin. And so at the top of page 210, there are quite colorful boxes up there. You can begin to see that we have these goods available for sale, and then we take those costs of goods available and we put them into the merchandise inventory or to the cost of goods sold, which is in the income statement. So when this merchandise comes in, it's going to either be an asset in the merchandise inventory in the balance sheet, or it's going to eventually go into the cost of goods sold in the expense account. And so that's the overall picture for a merchandising operation. Then we have two ways of valuing those inventories. One is that we can maintain it on a perpetual system. That's a constant record, just what perpetual might mean. I know that these are new words for many of you. You might not have, perpetual might not be a word, might be a word that you know, but not a word that you use. And so now I know I'm asking you to pull up words that you don't normally use. So perpetual is a constant record. You keep it ongoing. You keep it perpetually. You do it every time that you make a purchase and every time you make a sale. So that's what a perpetual inventory is. Now, a perpetual inventory system is becoming more prominent in our business world because we have these computer information systems and we have those scanners, and you and I know that they're scanning this inventory constantly. They know exactly which items are out there. They know which batch of purchases that was that came in, and they can keep a constant record. So we're finding that perpetual inventories are becoming much more practical, much more popular because they're more practical, and that companies are starting to use them. They use them especially for their reorder systems, where they want to make sure that they purchase the right goods and get them into the store on time as the inventory is changing. So that's a perpetual inventory. In the appendix at the back of the chapter, last topic, you will see a periodic system. Now, before all of this computer age, periodic system was the more practical and popular system, and businesses used this counting system where they went out and counted their inventory and said, well, this is how much I have left over at the end, so what is my cost of goods sold? And they used that cost of goods sold formula to calculate it. So we're seeing in the day-to-day operations perhaps less of the periodic inventory. Now, where you will see the periodic inventory still use is on the tax return. So the tax return and the financial statements, it's the one area, inventory is the one area where the law does not require you to use the same method on your financial statements as on your tax return. All the rest of them have to be the same, but inventory does not have to be the same. And so you'll find that you might see periodic on the tax return, and when you're having tax consequences discussions, or discussions about the tax consequences of decisions, that's a better sentence, people will be talking periodic inventory. But for now, we're going to talk perpetual, and we're going to say that perpetual is used for high cost, high tech operations. If we can get it labeled so that we can count it with a computer, all those barcode scanners that we see, then we're going to be on a perpetual inventory system, and that will help to resupply us with new inventory throughout the accounting period. So one of the things I want to add with my discussion for you this week, and it may make this video a little bit long, but I want you to look at perpetual inventory on page 210 with me, and I want you to look, and it says big green letters, the effect of 2013 events on financial statements. Now, we've been looking at this analysis since chapter 1, and that's why I think if you go back and read some of those early explanations, they will be very meaningful to you now that you've used them so many times. Now, the other reason that I want to do this is it has event 1, and it has in red, and it says acquired $15,000 cash, issuing common stock. Now, when we're doing our introductory problems, and when we're doing our Excel problems, and when we're doing our discussion boards, and when we're doing our comprehensive problems, you see these transactions. Your first reaction to reading that event in the problem should be to come back here to these red lettered items and find the item that matches the one you're doing. So you want to come back and find the transaction that's just like the one you're doing. So I'm going to ask you, even if you don't read the chapter ahead of time, read the chapter as you're working that initial problem, that introductory problem. And when you find that introductory problem and you find a transaction, come back and read this one. And then when you read it, I want you to read the red, and I want you to circle what you think is the key word in that transaction. So I'm going to say in this one, it's cash for common stock. That's the key phrase. Or just cash and common stock. Or actually the really key phrase is just common stock. So this is a common stock transaction. And if you only circled common stock, you could get to common stock much faster. And so they talk about it here. They say it's going to be a debit to cash because cash is an asset and going up. It's going to be a credit to common stock because common stock is an equity account and it's going up. And then they're going to tell you that it has an effect on assets, the asset specifically cash, and it has an effect on owner's equity, the common stock account, that contributed capital that came in from outside owners. And then it has an effect on cash flow because cash went up. So that's how they analyze this across the top. And you need to stop and read those and analyze them yourself carefully as you're going through each one of them. Because if you try to do the problem without coming back and finding the match of the transaction event in the chapter, you'll be spending a lot of time really just floundering, not really focused on the actual transaction. So when you read these, I want you to come back and look for the red letter item. Circle the dominant word or the operative word or the primary word. And then look at that transaction and then mimic that transaction in your own entry. Now then, the next one is a new one for us, and it says purchase merchandise inventory for cash. So I'm going to suggest to you that it's purchased is the key word here. And if it's purchased isn't enough, then you could do purchase merchandise inventory. You could do the whole phrase so that you keep it in mind. Now the reason I'm not using cash is that it could be for cash or on account. And so you may have an account payable here because you owe these people that money. So I want you to read those and then circle the key word so that when you're overdoing the problems and it's later in the week, you can come back to this very quickly. You can find it quickly because you'll have it highlighted or circled or underlined or something that lets you see it very, very quickly. Now then, when we look at this, they say this one's an exchange transaction. You're giving up one asset for another, as you did with the cash. And so then they say they're going to debit merchandise inventory. which is an asset, and it's going up because you have more inventory. And you're going to credit cash, the asset, because it's going down and you have less cash. So you reduce an asset with a credit and you increase an asset with a debit. So I'm going to debit merchandise inventory, the asset that's increasing, and I'm going to credit cash, the asset that's decreasing. Now, at this point, you should be reading these explanations, maybe underlining what you think is the key lesson, and thinking about how these affect what accounts are being affected. Now, if you look here, they're both on the same side of the equal sign because they're both assets. One's going up, one's going down. So you see a change in each of them. You see a negative cash flow because you had to pay out this much cash. And it's really quite simple if you look at it transactions at a time. Now, I've been asking you to work on your logic patterns, and both the emails I've received from the online class and the discussions I've had with the in-class, the ground class, that logic, you need to develop that logic pattern skill. You need to develop that logic pattern of I have merchandise inventory, that's an asset. I have cash, that's an asset. One asset's going up, the other asset's going down. That just basic rudiments, actually, fundamental rudiments of understanding accounts. And so don't let it go any longer to start learning these accounts, or at least become familiar with them by marking a page, because these are growing on you at an exponential rate. They're probably doubling right now every chapter. So you may have had 10 of them or 8 of them in chapter 1. By the time we get to chapter 3, you have 24 of them, and now they're going to double on you, at least 50% growth rate, if not more, this week. So this week you'll have 35, and you can look at that long list over there on page. Some of you are going to go, do I really know all of that? And that's just about income. I'm not doing the balance sheet. I'm not doing the statement of change in owner's equity. I'm not doing cash flows. I'm just looking at the income statement, and look at how much it's changed. This will be the sample you might want to follow on page 209. So keep that in mind, and really engage the events. Now, recognize sales revenue. Now, sales revenue is enough. You do need sales and revenue together. And so you have an income account that's going up, and you're going to sell this inventory. So it's really the recognized sales is the really key word. Recognized sales. That means you've got a complete transaction. You've exchanged assets with a customer from outside the enterprise. They're taking your merchandise home. You're keeping their cash or accounts receivable. And the sales transaction is complete. The title has transferred. They own the merchandise, you own the cash. So that recognized sales, there are 2 words that tell us the sales event is complete. Now then, we did it for cash. But notice in event 3, there's an A and a B. Because we're on perpetual inventory, we're going to recognize the sale, which is a debit to cash because cash is going up, and a debit to sales revenue and a credit to sales revenue because their revenue account is going up. They're both being increased, one with the debit and one with the credit. The asset with the debit, the revenue with the credit. So that's true. But in a perpetual inventory, you keep a constant record. So you keep a constant record. And 3B says the merchandise is in the asset is reduced and the cost of goods sold expense is increased. So now a new expense for you, cost of goods sold. And that cost of goods sold expense is going up because I've sold some of these items and I need to increase that expense with a debit. But now notice that I'm doing it for only the amount of the cost of buying the goods, not of the sale. In fact, the difference between the $12,000 I sold them for and the $8,000 for which I bought them is my gross margin. That's my margin that I'm contributing to the rest of my business because of the direct cost of these products. The rest of the money comes to my business. So now cost of goods sold is debited for the cost of the goods sold, which was $8,000, and the merchandise inventory account, that asset account, is reduced. You reduce an asset account with a credit, so you're going to credit merchandise inventory. Now, those are two transactions that are always written in harmony together. Now, I hope in this one, excuse me just a minute, you would say cost of goods sold. And when you said you were circling cost of goods sold, what I'd like you to do is say, oh, I'm working with cost of goods sold. Even if you haven't read the chapter before, stop and read it now. Circle cost of goods sold, underline the key lesson in that paragraph, study the schematic so you see the debit and credit that's in play, and then study the schematic so you see the effect on the accounting equation. In this one, of course, assets are going down, expenses are going up, so equity is going down, and there's no effect on the cash flow because there was no cash involved in this transaction. So I'm going to leave the rest of this section to you to finish. I've been talking already for 31 minutes, and I'm only on page 212, so I can't talk this much about every section, but I do want to give you a good setup here and be clear about the expectations that will help you be a successful learner. So as a successful learner in accounting, you're going to have to slow way down, read carefully, circle the key terms, use the red letter transactions as your guide for your transactions, when your events, when you see them in your problems, and then embrace the chapter. All right. Again, if you have any questions about these, send me an email, come by my office, ask in class. I'll be happy to help you. Then we're going to have ledger accounts and financial statements. So on page 213, you see that you have a set of events at the top. You have the T account transactions down below, so you want to follow those so you can see how they're posted. And then you have the financial statements at the bottom. So on page 213, this is certainly not as comprehensive as what you had at the beginning, but it shows you the net result of this set of transactions. Most of your problems look exactly like page 213. So that's a sample guide of how you go about looking at the event, recording the event, putting it in the T account so that get new ledger balances, and then preparing financial statements. We, of course, are adding a trial balance in here, so this is just a very synoptic approach to that set of events. When we get to page 214, there's some presentation there more about the cost of goods sold and an explanation, but again, the formula that's in the Check Yourself 4.1 is a formula you need to memorize. You need to put down. You need to study it. And we're going to expand it some with some information about the purchases. That part of the formula will expand for you in a couple of pages. But for right now, you have beginning inventory plus purchases means that's the goods you made available out in the enterprise to sell. The ending inventory that's still with you is your still on hand and is still yours. But the difference between everything available and what's left is the cost of goods. Now that cost of goods is cost of goods sold, cost of goods stolen, broken, shrinkage, removed for any reason from the inventory. We put it all to one expense called cost of goods sold. But intellectually, you need to understand as a manager that all that stuff didn't go through the cash register. Some of that stuff went with the jar of pickles that got broken on the floor and went through the trash can. So it's shrinkage, loss, reduction in inventory for any reason. But then when you get to sales revenue, the second part of this answer, notice that all sales is divided into two parts. It goes to cost of goods sold or to gross margin. So that means that cost of goods sold and gross margins are complements to each other. They add together to be 100% of sales. So they always have to be the complementary numbers. They have to be 70-30 or 60-40 or 50-50, but they have to add together to be 100% of the sales. 100% of the sales is in that equation, and that's a very important concept. And again, this is one of those areas where you need to study this, you need to practice it, you maybe need to look at some problems as you prepare for the exam to say, I got to practice this math if I'm going to be able to do it quickly in the test. So now that's the introduction to cost of goods sold, perpetual inventories, and the cost of goods sold formula. From there, now we're going to begin to examine some of these in more detail. So when we begin to look at transportation cost, purchases, returns, and allowances, just look at all the accounts you've got here, just in this title. Transportation costs, that's going to be both, that's going to be transportation in and out we're going to talk about. Purchase returns and allowances, that's one account together. And cash discounts, those are three new accounting events that you're learning, new accounts that you're learning, and new math that you're learning. So it's a big title. It's going to be a pretty busy section. Now, it says events of 2014, and the first one it does is a note payable. Now, we've been doing notes payable for quite a long time, so you don't find much explanation about notes payable. You just, at this point, we're hoping that you have an understanding of them and you can do that. And then you're going to purchase merchandise. And now with this one, excuse me very much, it's on account. So you have to say, as soon as I see that purchased and I see that on account, the first thing I have to ask is, what kind of account? Is it an account payable or an account receivable? Are they going to pay me a receivable, or am I going to pay them a payable? And I'm going to guess you're going to have to pay them, so it's a payable. So when you see that on account, you should be marking AP right up there against that on account, so you'll always remember that this one was account payable. As soon as you see it, that recognition should start happening. You should start asking yourself, am I going to pay them on this account, or are they going to pay me? And then I'll know, is it an account payable or an account receivable? So you see the transaction, merchandise is going up because it's an asset, account payable is going, and so it's being debited. Accounts payable is a liability, it's going up, so it's being credited. Now we have returned some of the merchandise. Now, you and I both know that we return things from time to time. Those of you who shop on e-commerce, we return things a lot. So these returns are more common, more prevalent than they've ever been. So now this return, we purchased something, returned some of the inventory purchased. It had a list price of $1,000. So what we're saying is, I'm sending this back. I don't want this merchandise. It wasn't the right color, wasn't the right size, didn't fit in with the patterns I was ordering, or whatever it was. Now it could be an allowance. I'm returning these because they were all broken. I'm returning these because they came damaged. Whatever the reason for the purchase return, or an allowance. You returned the whole thing, or you got an allowance for part of it that was not correct. So accounts payable now are going down. I don't owe those people as much as I did before. So I'm going to debit the accounts payable to reduce it because I don't have to pay them that $1,000. I returned those goods. And then merchandise inventory is going down, and it's an asset, so we're going to reduce an asset with a credit. So both of these are going down. Payables, down with a debit. Inventory, down with a credit. The liability and the asset. So as you read about this. Now you'll see there's much more information about returns and allowances, and so you can read about those. They go down through page 215, and then we come to purchases discounts. So another account, a different account. We've left returns and allowances. You've got a new account in your repertoire, but now we're going to another one. Purchase discounts are incentives to pay promptly. So a seller says, I will sell you this merchandise inventory on account. So they'll have an account receivable, we'll have an account payable. But if you'll pay me quickly, you can pay me less. So I will give you a discount if you'll pay this right away. Discount terms are terms like 1% off if you pay me within 10 days. 2% off if you pay me within 10 days. But if you don't pay me within 10 days, just wait and pay me after 30 days because you'll pay me the net amount in 30 days. But this is an incentive for quick cash return, quick cash flows. So purchase discounts are discounts on the amount of the purchase. Now we in business say that we're going to take all of these discounts because anytime I can pay less money, then, excuse me just a minute, the president of the university is here. I want you to know.
Didn't mean to make you get up. I was just going to say.
I'm giving a lecture online, and I said only for the president would I get up and
Sorry.
No, shake my hand so they'll know you're really here.
I was just going to say that you look like you had a bit of a public office there.
A bit. Bye-bye. Sorry, students, you know that for the president of your organization, you get up and say hello. So, back to purchase discounts. For purchase discounts, you will always take the discount because if you can pay 1% or 2% less for what you had, you'll part with the funds and pay for that. Later on, both in managerial accounting and in finance, we'll talk to you about that, a discount, and we'll talk to you about the effective interest rates. We'll introduce that to you here in this book. It's one of the reasons you ought to keep this book till you finish finance and then sell it back. But you want to hang on to this, and at least through finance, so you'll have this as a reference on your own shelf, and you can go back and read about discounts. And there are several kinds of discounts we're going to talk about in this class. So purchase discounts. Now notice, there's a math formula in here that you really need to notice, and it's given about halfway through the problem, and you should highlight those math formulas. You keep asking me about these math formulas. I went back and looked. I think we have seen the interest rate formula 4 times, and yet you're still asking me about it rather than having it highlighted in your book and marked with a post-it pad and interest written on that post-it pad somehow. Those post-it pads are cheap. Just buy a set and put them in your book and mark them down as to where they are so you can get to them quickly. Your time is too precious to be flipping pages all semester. So write these things down. With this one, you put PDISC, purchase discount, and put it right here on this page. And get the clear ones, and you can write on the ends of them. Or get the ones that you can write along the whole thing and put them here. The little narrow ones. So here you have the formula for purchase discounts. Now, since we're on a perpetual inventory, this is going to be purchase discounts will go against accounts payable coming down because I don't have to pay them that much anymore, and merchandise inventory coming down because I didn't have to pay so much for that merchandise inventory. Now, there are various ways of handling this. This is just the simplest, and it's the one we're showing in this book. As you go on in future classes, you'll see it in a much more complex setting and various ways of doing this. And any of you that become accounting majors, you will have debates about the strength or weakness of doing between those methods. But for now, notice that event 4 on 216 takes up the top 2/3 of the page. We have then event 5. Now, this is where I'm telling you to be an active reader. where I'm telling you to read and circle the key terms and highlight the formulas and picture in your mind what a purchase return is, and then maybe a discount for prompt payment. What would it be like to pay less because I'm going to pay right away? And so there will be, so take some time to embrace this concept, and then mark that journal entry. Now then, paid the balance due, and they finish that off. On page 217 then, they introduce you to the cost of financing the inventory. And here's that formula laid out in much more detail. And you really need to examine. This is that argument that I told you about financing. What's the best way to finance your inventory? This formula right here on the annual rate is equal to the discount rate. That's the percentage over the time. 365 days divided by the term of the loan. So when you substitute in, I wish in a way that you could see 365 over, if it's the term, a year, a month. When the term is only 10 days, this gets to be quite a high return. So if it was 365 days divided by 10 days, then we get 2%. In this case, it happens to be 20 days. So, and remember, it's 365 days, so you have to use days. You can't divide a year or a month into a day, to a set of days. So you have to keep those in days. And then it's a 36.5% savings. For a 36% reduction, we would go to a sale. And yet you're able to get a 36% reduction on every transaction you do. That's quite a significant savings. So look at this math here on the cost of financing. Begin to embrace why managers would want to make that savings. Now, the next topic, transportation costs. Transportation costs are transportation in and transportation out. That's you got to think about. We pay transportation when we buy the goods and somebody delivers the goods to us. And there's some transportation costs in many of these enterprises when we sell it and we have to ship it out to the customer. And so as we look at transportation costs, we want to think about who is responsible to pay these costs. And so the shipping itself actually goes by the term free on board. So when the goods are on the truck going, they're free on board. Somebody's paying that, the responsible person's paying that, and the trucker has no responsibility, no payment themselves. I mean, they have a responsibility to get it there, but they don't have any responsibility for the cost of those goods at all. So it's free on board while it's with the trucker. But transportation out means that I have responsibility for these goods until the point of destination. So transportation out, I'm shipping these goods and I have to make sure that they get there free on board. I have to make sure that they get there at the point of destination. Now it could be at the point of shipping. So I have responsibility for them. I don't have responsibility for them after they're shipped. The buyer is actually paying for the cost of the transportation. So you need to think about who's paying the cost. And in this day and age, I think we're seeing a mix, but in e-commerce, many times the companies will pay the cost of the shipping or the cost of the return. That seems to be one of the ways they get comparative advantage, is to free returns. You'll see that on e-commerce. Free returns. We'll pay the cost of the shipping. So does it start at the shipping point and then the buyer has to pay at the shipping point, or does the seller pay until the destination point? And that's covered for you on page 217 and 18. Now, they have then another series of transactions, and you get to recognize the revenue, recognize the cost of goods sold, pay the cash for the freight, and then pay the cash for the selling and administrative expenses. And as we turn the page, pay the interest on the note payable that we had to finance this this inventory. So that takes us through event 10. Now, actually, I did these on an Excel spreadsheet, and the event 6 is minus 600. Event 7A is the plus 24,750 when you buy it. Event B is minus 11,500. Event 7B, 8 is minus $450. Event 5 is minus $5,000. And event 10 is minus $360. And so as we look at all of these transactions, if I just look at all the direct transactions with this set of events that they're illustrating, my net gain on this is $7,140. Now, some people might question putting the repayment on the note as part of this. My assumption is that this repayment on the note is to pay off the inventory costs of that note to finance buying that inventory. If that's not true, then I wouldn't put the 5,000 in there. But what we begin to notice is all of these additional costs, and I want you to begin to think about the additional costs that we're incurring now with merchandising transactions, and I want you to begin to think about those in equations, fit them into equations. So we have then recognizing gains and losses on page 220 and 221, and they talk to you about what happens in this case with an important formula, page 221 in the check yourself box. They have the price of the inventory plus the transportation in that adds to the cost of the inventory. They have less the return, less the purchase price, the purchase discount, and then the balance in inventory. And so you could begin to use some of these, see them in formulas, see what they look like with pluses and minuses, and then with positive and negative signs. Again, at the bottom of page 221, as we think about these gains and losses, the first example that they give you is they bought some land and they sold it for more than they purchased it for, so they had a gain on the sale of that asset. And so a gain is an increase in our wealth, and that's the definition of increased in retained earnings, and so it's going to go into the retained earnings account as a gain on the sale of an asset. And as we look at the formula then on page 221, and then we look at page 221 at the bottom, and we look at this list of events that they just gave us, and then how they post those into the T accounts, and then across the page in 223, how they align those accounts into financial statements. These are what you need to study. This isn't oh, thank you God, no pictures. No words, just pictures. I don't have to look at this. This is study these schematics, study these exhibits, make the relationship between these T accounts and those events. If nothing else, study the T accounts, know the names of the accounts, know the normal balance of them, see how they have them listed for you as assets, liabilities, and equity accounts so that you can tell how they might be going up or down. And notice that they still have the check and the balance at the bottom of the assets equals the liabilities and equities, so that you should not forget that check figure. Many of you submitted work that was out of balance, and you could have found it very easily if you'd have just seen, what did I have the same amounts on each side of the equal sign when I was finished? And so the trial balance will also help you do that. So as we move in and use trial balances more, you'll notice your mistakes more prominently. When you're asking, where can I find a list of the accounts? Where can I find their balances? Another page, 222, 223, and how those are presented and in what categories. Now, they present this information on this multi-step income statement, which you saw out there on page 209, and the single-step income statement. And so they give you some explanation there. You should look back at page 209 and 210 at the pictures when you're reading about the paragraph on each one of those. We will be using both of them, and you use them for different reasons. So it becomes important that you know the difference between them, at least in your head, and how we would use them. Then we have damaged, lost, and stolen inventory, and I've talked about that. And so you can begin to see inventory loss as an expense. It's part of cost of goods sold, and so it'll go in there, especially if you know exactly which part of which inventory items were lost or broken, or you won't know which just disappeared. Those will be melded into cost of goods sold. But we do have inventory shrinkage accounts. You'll use a lot of those in 252. Inventory shrinkage, inventory losses, and in those of you who become accounting majors in cost accounting, and also in finance, where we're wanting to know when we're trying to track our cash flows. Now then we go to effects of sales. And when we look at effects of sales, they are on page 222 to 228. And we have these transaction analysis for each of these red transactions. So again, sold, merchandise, and then these terms. So we would circle sold, merchandise, and the terms. And then we would know what we were working with, what kind of transactions we were going to have. And then again, recognized cost of goods sold, a customer event, returned. So we have returns, and then cost of goods sold to put it into inventory. That's the B part of a perpetual inventory. You always have to record the return, and you always have to record the change in inventory, and they're done at the very same point in time. So you're seeing these as A's and B's. Now, event 3 is accounting for sales discounts. Here's another account. So we've talked about purchases discounts. Now we're going to look at sales discounts. Sales discounts are when you offer your customers an incentive for prompt payment. So you offer them a discount and tell them, you pay us quickly and we will give you this discount. Same math, same ideas, but now you're reducing your revenue instead of your expenses. So you're reducing your revenue for a sales discount. A discount to your customer that says pay us promptly and you can pay us less. Now again, the terms are going to come 1% in 10 days, 2% in 15 days, 3% in 5 days, whatever it might be. And you're going to have to work with that percentage in the number of days. So 210 is 2% in 10 days. Or you can pay us the net in 30 days. Now, as we look at these sales revenue, that's the first one that we have, and we look at that, they're going to show you some alternative ways to do this. So one alternative way is to recognize the discount right at the time of the sale and reduce sales revenues as they're doing here. Another one is that, and then you recognize the sale only at the net of the discount. Instead of $7,500, you only are going to recognize $7,425, and you recognize the discount right away. Alternative 2 is to collect the full amount, and that's on the top of page 222. And what you do here is after the discount period has expired and they didn't take the discount, then you put the discount back in. And so you put it back in. You put it back. Now, another way of doing that is to wait and do all of this later. But we're assuming that people will take these discounts, and if they don't, then we have these additional revenues because they didn't take the discount and we're going to make more money. So when we look at that transaction, we began to see that they did not take the discount. We didn't have to reduce our expenses, but our revenues by that amount. So we put it back into the revenues and with a credit, and we put it back into the accounts receivable with a debit, and we say now they're going to pay us the full amount. All right, sales discounts, very important concept when you're actually looking at your company's overall revenue. Now, the common size financial statement is shown to you at the bottom of page 228, and this is a common analytical tool. And so we're beginning now to look at these ratio analyses, look at these common size financial statements, and notice that very short presentation on accounts, compares 13 and 14, and the common size means 100% of this is sales. So that's common to both of us. 100% is sales. But then what's the breakout between cost of goods sold and the gross margin? So in the first year, the cost of goods sold were 66%, 66.7, and in the second year, they were 46.5. So by the second year, they'd really gotten a handle on those costs and been able to reduce the cost a great deal. So now instead of 33% of every sale going to cover the rest of the cost of the business, now 53.5% of every dollar that's sold is going to cover the rest of the business. So that lowering of the cost of the goods sold, that good management on merchandise inventory, allows for much more money to be reserved into the business and be used for our other costs. Now you want to look down these percentages. Obviously it's a percentage of sales because sales is 100%, so all of these numbers are taken at a percentage of sales, and then we find out what percent is the return for us in our profit, in our net income. And it went from 25% to 32.9. So that's quite an improvement, and also gave us more money to spend on our own operations to make us more competitive. So you want to think about the valuable information that comes in a common size income statement. Ratio analysis, we're adding more and more ratios for every chapter. And so every topic you're going to get new ratios. Again, I encourage you to start a ratio page, and I'll talk to you about where one is in the book as we do more of these. But we're now looking at the gross margin percentage, and so that's gross margin divided by net sales. And so everything will be divided by net sales because we're doing this common size. We're wanting to see that. The next one is net income divided by net sales. So now this is the final net income at the bottom, and that gives us our income percentage. People are outsiders and insiders are very interested in both that gross margin, how much are we spending on the direct costs of this product in order to get it to our customers, and then how much are we spending in our own operating costs and having the business grow in net income. Now people want to know both inside and outside the enterprise. Future investors in the stock, future investors in the loans, future managers in the future who want to see analyze past performance. So it goes with a particular company, it goes between companies. And then they give you some information and give you an example of that at the top of page 230. And you want to notice how that's done, how that's set up, an example that you can use. They give us these real-world experiences and real-world data, and they give you a presentation here about these companies that are at the top of page 231 that can help hone your analytical skills, help hone your understanding of these types of conditions, might help hone how you could analyze your business for a presentation. Then the look back. This time I want to really encourage you. I just started looking through the look back, and I wish you could see my page. Just circled, and if I had a highlighter here, I would have highlighted all of the italic terms, all the terms we've learned this chapter that are put in italics. And I want to tell you, on just the very, very bottom of 231, I have 1, 2, 3, 4, 5 that are circled, and I have 3, 4 that are underlined, and I have recognized great with a great underline, because we're really working on that term of what we're going to recognize and put in the books and what we're not going to put in the books. So I want you thinking about that, and when I turn the page I get even more. So I would say this particular chapter, there's so many new terms. I would encourage you in the look back to just highlight the term and then read its explanation, and highlight the term and just read its explanation. Don't highlight the explanations or you'll be highlighting the entire passage. You just want a quick identification of where you can get information about those topics. And then they give you the appendix on periodic inventory, and it's not very long. And what it basically does is, the most important thing that it does is it tells you that you have a purchases account, and it's an expense account, and it's an expense account you need to learn. That's why I have the appendix as part of the reading, because you need to read about purchases. It's an expense account. It's how you can tell if a company is on a periodic or perpetual inventory. If they're on a perpetual inventory, they don't have purchases. But if they're on a periodic inventory, they have purchases. They have that expense. And they're going to have purchases, returns, and allowances, and purchases, discounts, just like we have sales. And so they're going to have those matched against purchases rather than putting them back into inventory, but the way we do with periodic, the way we did earlier in the chapter. But please read about this periodic system. Under the periodic system, all new acquisitions of inventory go into purchases expense. So all new inventory you acquire goes into purchases expense. And then you count the inventory at the end of the year, and the difference between everything that's in purchases and everything that's in the ending inventory is cost of goods sold. So, goes into purchases, is counted as purchases expense. And this formula then becomes beginning inventory plus purchases equals goods available, just as we saw earlier in the chapter, but it's a much fuller purchases expense account. Periodic is for companies that don't have enough technology to be scanning and recording transactions as they happen. They're for low-cost items. There's just too many of them going on. And they're for high turnover items, like you might see in a grocery store, or just think about the lines at Costco or Walmart or some of those places, and you couldn't possibly be writing journal entries for every one of those sales. So you would just be using a periodic inventory system. As I said, perpetual inventory systems are predominantly used now in keeping track of the new purchases you need to make. All right, well, that brings us to the end of the chapter, brings us to the self-study. I always encourage you, when you're finished working through the chapter, read the self-study, see if you can do it. Look at the answer that's over there. And I wanted to make sure that you looked at the exhibit 412. So that's that cost of goods sold formula that's at the top of page 234, and it's the one that has purchases in it, and it shows you how to do purchases, returns, and allowances. So be sure, again, the formula at the top of page 234 is where you see the cost of goods sold formula with purchases. And remember, I told you to look at, the cost of goods sold formula on 214, so they're just 20 pages apart. 214 is for periodic inventory, is for perpetual inventory. 234 is for periodic inventory. Well, it's hard to believe, but I can believe I did it. I've talked for 1 hour and 10 minutes, except for the interruption from the president, and I've talked about as fast as I could, and tried to point out as many important things as I can. I'm looking back at my notes just to make sure that I told you about these items. And I can't encourage you enough to spend some time with the book. Read the chapter. I know it's long and hard. Maybe read one set of events at a time. Just read the first set of wherever the big first heading is for green letters type of transaction, and read about those and work those and quit for the day. And then the next day, read the next ones. Quit for the day. You don't have to read them all at one time. Might do your mind good to get a little rest from time to time. So that's my overview of the merchandising business, sales, and businesses that generate revenue by selling goods, and they purchase them to resell them again, and they purchase new ones to resell those, and they're called a merchandise inventory. Welcome to week 5. Welcome to chapter 4, and may it be a very productive week for you in learning all these new accounts. Goodbye for now. I'll be making more of these videos for you about the chapter. See you then.